Hi, I'm Corey. I'm a CPA and subject matter expert in financial accounting. And in this video, we're going to run through the application of the income recognition principles, also known as revenue recognition. We'll start off with a high-level overview of the revenue recognition principle and criteria. Next, we'll dive into the application of these principles in order to determine how we recognize revenue in the financial statements under a variety of scenarios. Understanding how to recognize revenue is extremely important to present the true and fair view of the financial position of the business. So let's get started. Revenue is a crucial component to the operations of a business. Most organizations are looking to report as much revenue as possible because it sends the message that the company is operating successfully. More revenue generally means that the company is generating additional sales and growing over time. However, determining when and how much revenue to report is not always as straightforward as it seems. Many questions arise when looking at this topic. Can a company record the revenue for a sale as soon as the customer signs the contract? Or do they have to wait until they physically receive the cash, or until the goods are delivered to that customer? What about when they're performing a service instead of selling a product? These are all great questions, and we'll answer them in this video by looking at a few common scenarios. But before we dive into the specific revenue recognition criteria, let's remember that revenue is the amount earned when a company provides a good or a service. For example, ABC Company sells you $500 worth of goods. Thus, the amount of $500 will be revenue for ABC Company once the revenue recognition criteria have been met. This is where the accounting standards come into play, helping us to determine the timing of when the revenue can be recognized using the revenue recognition principle. Both US GAAP and IFRS require that revenue is recognized on the income statement in the period when it is earned, not necessarily when the cash is received. As soon as these criteria have been met, the company can record the revenue. Now, there's two general criteria for revenue recognition that we'll be referencing in this video. The first is that the seller must have substantially performed its obligations to the customer, meaning that the risks and the rewards of ownership have been transferred. This means that companies have to hold off on recording the revenue until the product has actually changed hands with the customer or the service has been performed. The second criteria is that the seller must have either obtained monetary payment from the sale or be reasonably sure of collection. Both of these two pieces of criteria have to be met in order to recognize revenue in the financial statements. Now let's apply the criteria to an example where a portion of the revenue can be recognized at the time of the sale, with additional amounts being deferred to a point in the future. In our example, ABC Company operates a large retail store that requires customers to pay an annual membership fee to shop there. A customer comes in one day and spends a total of $680. This purchase was made up of an annual membership fee of $60, $120 spent on groceries, and $500 spent on the purchase of new tires. The tire purchase also included installation of the tires, plus additional maintenance and wheel alignment services over the next 2 years. So how much of this $680 can be recorded today at the time of sale? Well, we need to look at the substance of each of the elements of this purchase in order to answer that question. First, let's look at when should ABC Company recognize the revenue for the $120 worth of groceries. Now remember, the first criteria from earlier was that the seller has to have performed its obligations in order to record the revenue. In the case of the grocery purchase, this would occur at the time of sale because the company has no further obligations after the groceries have been sold. The second criteria was that the company must have received payment or be reasonably sure that they'll receive payment. In this case, again, since the groceries have been purchased at the time of sale, this criteria has also been met. Since both of the required criteria have been met, it's clear that the full $120 can be recorded as revenue at the time of sale. But what about the annual membership fee and the tire installation? Well, we'll come back to that in a minute. It's a common mistake for companies to recognize revenue too soon before they have actually earned it. We need to remember that just because a company has received cash from their customers, it doesn't automatically mean that they can record the revenue at that time. It's a common mistake for companies to record cash when they receive a deposit for future services at the time they receive it. However, all revenue recognition criteria must first be met. If the service has not yet been performed, the company must record the cash as a liability until the service has actually been rendered. Now that we've cleared that up, let's continue along with the application of the revenue recognition principles. We've already covered the groceries, but what about the $60 annual membership fee? This one is a little bit more difficult to determine the timing of when the company can actually record this revenue in their financial statements. Can they record the full $60 as soon as they receive the cash for that annual subscription? Or do they have to wait until the full year passes? Well, let's look at the first piece of the revenue recognition criteria again from earlier. The seller must have substantially performed its obligations to the customer. Now, in this case, the criteria has not been met at the time of sale, since ABC Company has an obligation to provide the customer with membership access for that full year. This means that at the time of the sale, they would need to defer the revenue for the remainder of the year by accounting for the $60 as unearned revenue. This is a liability account because at this point in time, the company still owes the customers this service. So at this point, no revenue for the membership fee has been recorded. Which brings us to the next question, which is when and how can the company actually record revenue from this sale? Well, if we go back to the criteria number 1, we remember that revenue can be recorded once the risks and rewards of ownership have been transferred. In this case, that will happen in multiple steps on a monthly basis as the service is provided over the span of that annual membership. This means that ABC Company can take the annual $60 membership and divide it up by 12 months in the year for a result of $5 of net revenue that will get recorded in their financial statements each month of the year. As you can see, for this revenue stream, the company is slowly earning $5 of revenue each month as they provide access to their location throughout the year. Let's talk about the final revenue stream, which was the $500 which the customer spent on the purchase of new tires and 2 years' worth of maintenance services. If we apply the criteria from earlier, we note that ABC Company performs its obligation here at multiple points in time, meaning they won't be able to record all of the revenue at the time of sale. Their first obligation is fulfilled at the time of the initial installation of the tires. At this point in time, the company would be able to recognize the portion of that $500 selling price that's applicable to the sale of the tires and installation services. Let's say that accounted for $350 worth. This means that they would have to defer that remaining $150 of revenue until they fulfill their obligation to provide maintenance and alignment services over the next 2 years. Since at this time they would still owe 2 years' worth of maintenance services to the customers, this $150 would actually be considered unearned revenue for the company. Now remember, unearned revenue is a liability since the company currently has possession of the cash, however has not yet technically earned it since those services have not yet been provided. In this case, the company would have to wait until they actually perform the maintenance services over the next 2 years to recognize this portion of the revenue. Let's say they plan to provide 2 maintenance appointments to the customer over the next 2 years. Well, then they could recognize one half of that $150, being $75, after each service appointment is complete. As we can see here from this example, revenue recognition can be a very complex topic. However, as long as we keep the criteria in mind, it can help us determine the correct course of action in a variety of situations. And that brings us to the end of this video. Remember, the ability to generate revenue is critical for the success of a business. For that reason, it's important that we understand the rules and the criteria that determine when revenue can be recognized within the financial statements. The ability to grasp and implement this concept can have a significant impact on a company's financial reporting. If you're interested in learning more about these types of topics, please feel free to watch our additional videos.